privacy, debt, risky investments, and Chinese bankruptcies. Oh my, we have a lot to talk about today. Headline commentaries coming up. I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service gold and silver dealer specializing in strategies to help you through, and dare I say it, thrive in the reset that we are already walking through. And today I wanted to talk about some of the things like this just caught my attention. Google amasses personal medical records. They teamed up with one of the US's largest health systems in Project Nightingale, where they actually, I'll do a little bit more on this, but they can actually, through artificial intelligence, determine what you as the patient needs. Maybe you need a new prescription, maybe you need a new doctor, maybe you need a new... I don't think I want Google's AI telling me, but boy, they're getting all of the information that they need, and they don't even have to tell you about it, or at least they haven't told you about it yet. They've been working on this for a while. I would say that's definitely an oh my. But I also need to go back and talk about debt, because mounting card debt traps more drivers. So what people are doing, and it's at the lower end of the income spectrum, where they go out and they get a clunker and they borrow to get that clunker, pay outrageous interest rates, but then they have to get a different one and they haven't finished paying off those balances. So the car companies or the finance companies are allowing them to roll that debt into the new loan. And again and again and again, it is a trap. They will never get out of it. And some 33% of people who traded in cars to buy new ones in the first 9 months of 2019 had negative equity. It was 19% a decade ago. So when people think, well, look at how great the economy is doing, from 19% that had negative equity in their cars to 33%, rising car prices have exacerbated an affordability gap that is increasingly getting filled with auto debt. Easy lending standards are perpetuating this cycle, with lenders routinely making car loans with low or no down payment, and they can last 7 years or longer. So you've got a lot of debt in there right when the economy is slowing. Lower imports point to a slowdown. The decline was led by a 4.4% drop on imports of consumer goods. This is a problem. We're counting on the consumers to keep everything floating. So what is this telling us? The markets are telling us, hey, happy days are here again. Everything is great. But the underlying data is telling a completely different story. It could be a sign that the U.S. consumer is possibly curtailing spending. God forbid. We should not want that to happen. In the meantime, U.S. job openings declined in September. So are we having a shift in the consumer's ability to take on more debt and keep everything floating? And that is also a problem, because pensions embrace riskier investments in the hunt for returns. Now, look, we already know that we've got a retirement crisis, not just in the U.S., but globally. And because interest rates have been held for so long, low for so long, of course they're going out on the risk spectrum. Let's see, asset classes, including private markets, real estate projects, infrastructure financing, and direct lending. Here's the problem, is the mismatch between the promises that the pensions have made and how liquid those investments are. So I think when push comes to shove, this is going to exacerbate an already critical problem in terms of retirement. But going along with those riskier investments, and we've talked about this in the past, ratings firms have a broken rating model when it comes to a lot of these debt obligations, which we're going to talk about in just a minute. It is an issuer pay business. Which means that if I want you to issue a bond or issue a credit rating on a bond that I'm going to issue, I want the best rating possible. They know that this model is broken because we saw it back in 2008 when you had those CDOs that were really junk quality. What they were washed and manipulated into AAA. We're doing the same thing with CLOs today, and the rating agencies have been really changing their standards. So have they changed that model? No. You still have the issuers of that debt going out and shopping the rating agencies to see who's going to give them the very best rating. But in an attempt to get those consumers continuing to consume and giving them the ability to take on more debt, a job license could get you a loan. So Experian, the score was created, this is a new score. It was created by credit reporting firm Experian, and it's called Lift. And their new score is the latest change, because we've talked about other changes, aimed at helping lenders make more loans to consumers with no or limited borrowing histories. The potential field is huge. About 53 million U.S. adults don't have credit scores. Oh my God. In some cases, Lyft will factor in only positive information. On-time rent payments will be counted, but missed payments won't. So this is who you're going to give loans to. Key in here, especially when we're thinking about the liquidity issues or the stock market issues, is declining liquidity. Low liquidity spurs volatility in earnings season. Over the past 2 years, this low decline in liquidity has stoked volatility around earnings. So, liquidity is your ability to easily buy and sell. Well, what they're saying here, and what I've been talking to you about for quite some time, is the loss of actually since 2013, is the lack or the loss of liquidity in the markets. You may think you want to sell, but you need a buyer on the other side. And with so many of these derivatives, ETFs, ETNs, CDOs, CLOs, it's a whole vegetable soup. You may not be able to get out when you want to. Right now, sure. But when push comes to shove, I've also been showing you how there have been a growing number of firms where redemptions have been frozen. So you need to keep that in mind. Because stocks around the world and commodities have logged a rare synchronous rally this year. Everything's going up. I'm going to be talking about that more tomorrow. But here's also a key, is farmers turn to high interest loans. Financial stress is mounting in the Farm Belt, pushing more growers to take on high interest loans outside the traditional banks to stay in business. So right now we have farm real estate that is near a high. What happens if the farmers go out of business? Who's going to feed us? Will it just become this one big commercial farm that uses Monsanto seeds and Bayer seeds? We know who controls the seeds in this country. That scares me. That actually scares me probably more than anything that I've read, because we already know how the food quality has declined so much as they push for that production. Something that we just recently talked about too are loan deals offer bad omen for junk debt. We just talked about this and the fact that a lot of those deals are souring, and we're in an environment right now where interest rates, market interest rates, are rising. Central banks are pushing the interest rates down, but the markets are pushing them up. We have to pay a lot of attention to this because this could easily collapse the whole system. So that's it for today. Have some more things, but we'll save it for another day. And keep in mind, I just did Dustin Nemos, so that should be posted shortly. Next week is SGT and Sean. Always a good interview. If you have any questions, send them to questions@itmtrading.com. And don't forget to visit our blog, itmtrading.com/blog. If you like it, give us a thumbs up. Give us a call if you need us. And until tomorrow, be safe out there. Bye-bye.